Hello and welcome. You're watching us here on CNBC TV18 Mumbai Newsroom. I'm Manglam Malu and you're watching the Mutual Fund Corner. Remember, every Tuesday and Thursday we speak about the mutual funds. As of now, the markets are pretty much in a band. Mild moves on either side for the frontline indices and the Nifty Bank. So let's take a step back and talk about the larger goals of investing, financial planning as well, and financial planning, which is a larger group as against investment, which has both been, interchanged or used interchangeably. What are the differences between investing and overall financial planning? We'll connect with Harshvardhan Roongta, who is the CFP at Roongta Securities, to talk about holistic financial planning. And a little later, we'll also be joined by Anubhav Srivastav, partner and senior fund manager at Infinity Alternatives, to discuss a tactical portfolio. So let's talk about financial planning as a whole, the holistic financial plan that we keep talking about. Harsh, thank you so much for joining us, taking the time out to explain to our viewers what exactly financial planning is. Because, when we speak about a financial plan, the general tendency is for people to assume that it revolves only around investing, and that's been used interchangeably. Can you explain the parts of a holistic financial plan, of which investing is a subset and not vice versa?
You're absolutely right, Manglam. When we talk about financial planning, for whatever reasons, people have been confusing themselves to only investing their money. So it's not only investment planning. If I need to go into the details, there are four phases of financial planning, or rather the four important aspects that you need to keep in mind. The first one being, you have to ensure continuity of income that your family enjoys today. Whatever you're earning today needs to be ensured that that continues to come to your family, irrespective whether you're there or not there. So, problem would occur in such a situation only in case of death or disability of an earning member of the family. That's the first phase that you need to ensure. How to go about it, we'll probably discuss later on in the show. The second element that you need to keep in mind is the preservation of your existing corpus that you've created. So until today, you may have definitely started investing and accumulated a certain corpus which you're trying to feed into for your future goals. You need to ensure that this capital or this corpus that you accumulated till now does not get exposed to some exigencies which come up, such as could be hospitalization or an illness. You need to protect that. The third step comes into planning for future goals and aspirations. So you may have certain requirements in the future which you will start saving for. That is where investments come into picture. And the fourth phase of financial planning involves smooth transfer of your assets to your next generation. So it could be the legal heirs or anybody whom you would love to transfer your assets to. That comes into in the fourth step. So as I would say, if you notice, there is far more than just investment planning into the holistic financial planning aspect that we look at. In fact, if you notice, the investing actually comes into picture only after you've fulfilled all your insurance requirements, which is providing for all the risks that you or your family are exposed to. Unfortunately, if you look at insurance, nobody kind of pays that much attention or gives importance to the subject of insurance. And there would be very few who would be seeking professional consultation for this. All this while we know people have been buying into insurances only to oblige their relatives, or probably forced by their parents to, if they want to buy a locker or something like that. So insurance planning is in fact the first step of financial planning and needs to be taken very, very seriously.
All right, we take that point. In fact, in what you said, it needs to be taken very, very seriously. It couldn't be said with so much more emphasis earlier, because last year itself has exposed all of us to so many vulnerabilities in people's financial planning, where they should be looking for gaps, etc. And given the new financial year is just around the corner, just a few days from now, this Friday itself, what actions do you recommend taking, and where do you think are gaps which people tend to usually overlook?
Sir Manglam, I would like to first emphasize upon the aspects that we spoke about. So if you may just understand a little bit more in detail and how we can fill those gaps. So there is where we'll be able to identify those gaps. So if I look at the first element, as I said, that to ensure the continuity of income that your family enjoys today should continue to come. So here is where we're trying to refer to, saying that if an earning member of the family is no more or gets disabled due to certain reasons, there is a loss of income which they enjoy today. So this needs to be filled. This gap that you asked for needs to be filled with adequate life insurance. And the only way to do this is in the form of a term plan, which is providing you a large coverage at a very nominal premium cost. How much should be the insurance is also another important aspect. So if in the absence of any data in general, if you have to see, it would be 10 to 15 times of your annual income. to be some kind of disruptions in income due to disability and illness, there are specific general policies available which cater to the requirement of financial security in case of disability and illness. If you look at accumulation preservation of your accumulated profits, then of course you need to have a medical insurance policy and make sure that you have an insurance policy which covers not the cost of only present treatments. You have to keep in mind inflation. 5 lakhs may seem like a good cover today, but 10 to 15 years down the line, given the medical inflation, it's not going to be sufficient. So you need to make sure that you have enough of medical insurance as well, which covers costs potentially after 10, 15 years in future as well. So you will not have to wait, have those pre-existing diseases, waiting period effective at the time you buy a new policy later on. Then of course planning for goals and the future. You cannot have your future secure when you don't have your present in place. So present has to be kept in order and then you plan for your future. Last, as I said, of course, is the smooth transfer, and you need to make sure that you have bills in place. Many people have a myth, under the myth that you need a lot of investments or larger big asset base in case you need to transfer, you need to create a will. No, that's not true. You can create a will even with a very minimum asset base at this point in time. Is just to ensure that your assets are transferred smoothly to your next generation. And you also, at the same time, many people are under the belief that there is no dispute in the family, so they don't need a will. Well, that's not true again. So just ensure that you put these basic hygiene factors into place. And now, as you said, that what are the gaps? Well, we have seen in the last 1 or 2 years that people have lost their lives due to pandemic. There have been a loss of job, pay cuts. There have been a lot of such things. We've seen people who dependent on their employers for medical insurance. And the moment they lost their job, they lost the medical cover. And in between the pandemic, to lose a cover like this was not a very good thing to do. So ensure that you have, just sit back, take a pause when you're just at the end of the current financial year. Look at the situation, what are your gaps in terms of what we've discussed till now, and please fill it up first without going into the new year overexcited and look at only things which are very trending in nature and very, exciting in terms of investment. You need to look back, sit back, take this financial year as a pause and start afresh in the new financial year, filling all the gaps that we spoke about until now.
Right. You did speak about family briefly. It happens in a lot of families, including mine. I'll be very candid here. How can family members actually be kept involved and informed about financial plans, financial goals, financial documents of importance as well to help them achieve their goals and keep the continuity alive even when, there are accidents or things which are unforeseen take place? Well, we'll try to repatch that connection with Harsh in just a bit. But, of the conversation that we've had with him so far, he's spoken about a financial plan which usually is used interchangeably with an investment plan. But that's not the case. An investment plan is basically a subset of the financial plan. He's spoken about continuity of income, continuity of preservation of accumulated capital, investing for future goals and aspirations, at the same time smooth transfer of assets to the next generation. And speaking about the next generation itself, we have him back with us. Harsh, how can family members actually be kept involved?
Okay, so Mangalam, the simple way would be to begin with is to introduce your family members to your financial advisor, to your lawyer, to all those people who make a difference and who are involved in the financial planning aspect. So you could have your insurance advisor, your financial advisor, your lawyer. They need to know and be introduced to your family members. That's the first point. And you need to give them the contact details so they can be contacted independently even if you're not around. The second would be, most simple thing is again to collate a list of all your investments, and please make sure you hand over those investments, the list to your family members, so they know what
it is there who's going to be more than one person. Rather, I may put this. There should be more than one person who knows about all your investments. Now, when you talk about these passwords, in today's times, we're all governed by our passwords, OTPs, etc. And it will not be possible for individuals to share all those details with the family members. So, one way out to that is that you create a common email ID. Okay, that could be just say finances dot, and you can use the name say Mangalam at gmail.com. You could have a common email ID wherein you link that email ID to all your investments and all your insurances. So even if you are not there, that common email ID can be accessed by other family members, and they can have access to all those passwords and OTPs that come in for your investment. So that is one possible way that you could actually go about doing this.
All right, we take that point. In fact, just for those who may have been subject to a bit of a muffled audio out there, let me just recap what Harsh said about, keeping your family members involved and informed. It is important to keep them involved in terms of your investment, and insurance must introduce your family members to, your advisor, lawyer, so that they can connect with them in need. And the list of investments should also be shared with family members. And finally, there must be a common email ID for all investment / insurance related documents, and that should be shared only with family, nowhere else, to protect continuity and safety, and that everyone else is better informed. It's the start of a new financial year coming this week itself, so we wish you happy financial planning, most importantly responsible financial planning as well, and well-informed one at that. Thank you so much, Harshvardhan, for joining in and helping all our viewers with that. With that, we slip into a short break. On the other side, we talk about another aspect of financial planning and investment. Anubhav Srivastav, partner and senior fund manager at Infinity Alternatives, joins in to discuss what a tactical portfolio is. Stay tuned.